Time now for Options Corner. Joining us to take a deeper look at the chart for Boeing is Rick Ducat, lead market technician. What a different year Boeing is having than last year or the year before that. Why don't you take us through the trends you notice in this chart, Rick?
That was exactly my thought, too. For a while, it felt like every headline you read about Boeing was bad, but it seems like now the reverse. It seems like it's always positive news whenever I see this company. But when you look at our chart here, Boeing outperforming not only the S&P, but also its own industrial sector, XLI, and the Jets, aerospace and defense ETF here. But when we look at some of the major players in this sector here, GE is the one at the top of the pack. Boeing is more in the middle, behind Raytheon, but above General Dynamics and Northrop Grumman here. So if we were to look a little bit more closely at Boeing's chart specifically, we can see that we have been trending downward here for a while after hitting these highs near 243, just below that area. From there, we established a bit of a range between 210 on the downside, 225 to the upside. We slipped below that level. Now, for the most part, we've been holding on in this zone between our lows near about 195 and this other series of high points here from back around this time period and this time period early this year. So between about 188 to 195 really stands out as a potential supportive area. When we also were to look at our moving averages and our RSI, we can see that RSI, even though it remains quite low, is still above that oversold threshold here. So hanging on a bit with that would be another bearish crossover signal here. We can see that our 5-period EMA comes in right around 195. So that could be a short-term resistance point here as well. But we're also getting a bit of a confluence between our two other moving averages here, our 21 and 251-day exponential moving averages. Those come in right around the 201 level or so. We can see for volume here that we also have two nodes that have formed in this area here around 175 or so, and this area around 205. So those could be some further support and resistance marks to consider as we move forward in this name.
Thank you, Rick. That's Rick Ducat, the Duke of Data himself, with a look at that chart. Now to take us through an example trade, we've got Tom White, co-host of Fast Markets, senior options contributor. All right, Tom, so what's the approach you would take for an example trade for Boeing, especially in this day and age?
Yeah, a lot of good news out of the Dubai Air Show coming online. And then also they're going to start to increase production. This is all about free cash flow and how fast they can get production back up. So that's what you got to look at. Rick talked about the technicals. This 191, 192 level has been an area of support over the last couple of weeks. So I looked at a strategy that maybe takes advantage of the fact that maybe that continues to hold. The stock's going to open up about $195 here this morning, up just a little bit on the back of these orders that they had. But so I looked at a cash secured put. But that's pretty expensive, right? It's real capital intensive because you're selling a naked put with the expectations that the stock's going to kind of consolidate, maybe go higher, maybe even go a little bit lower, staying above a specific strike that you sell. But it also comes with a lot of capital risk on this if the stock were to somehow continue to go lower all the way to zero. So it's capital intensive. So I looked at a strategy that widens out a short put vertical that's neutral to bullish. But I'm buying a put that's farther out of the money that doesn't really detract from the credit I'm collecting on the put that I'm selling. So I went out to the December 5th weekly cycle, 18 days to expiration on this one. So you got about 2.5 weeks. We're going to sell the 190 put. That's out of the money by about $5 to the downside. And then against it, because I want to lower my input risk on this position, my buying power risk. We're going to buy the out-of-the-money 170 put, so a short $20 wide, neutral to bullish put vertical that you're going to collect about $275 credit. Now, if you were to just sell the 190 put, you'd collect about a $3 credit, maybe a $3.10 credit. Well, I can take away a bunch of risk by buying that further out-of-the-money put that's $25 out of the money, to offset some of the risks on this. Now, if the short $20 wide put vertical, I'm going to collect $275 credit. That's what I can make, $275 per spread. With the break even down here at 187.25 to the downside. That's 4% below the current share price. So I'm giving myself a big cushion to the downside on this neutral to bullish position here. But by buying the out-of-the-money put down here at the 170 line, it really reduces the amount of risk that you have to trade this type of strategy.
All right. Thank you, Tom. That's an example trade there for Boeing. Appreciate that.